When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
Good afternoon, everyone, and welcome to MacroEdge Radio. And all I can say is, holy cows. See, I cleaned it up for radio. We are tuning into some historic events this week. We have most of our crew with us today. This is going to be one of the most unbelievable shows that we've put together in a long time because we're truly living in historic times. And when I say historic times, I don't mince those words lightly. In fact, normally I wouldn't do this, but today's market calls for a brief musical interlude. Sorry, I have a crappy audio setup. I couldn't interface it directly, but yeah, we went downtown today, boys and girls, with higher pain, higher volume, and more agony than you could ever imagine for the markets. This was downtown in every way of the word. I've never seen anything like this since 2008. I mean, it was obscene. And when people sit there and say, well, that wasn't that bad, blah, blah, folks, there was more pain than you could imagine being inflicted on people today. And when I say that, I mean that with every word and fiber in my soul. Most Americans are used to quiet, calm, rational markets. We've raised an entire generation on crony capitalism, perpetual bailouts. The Fed is always there for you, and everything's going to be okay. Now, I'm a historian by trade. I'm not a freaking market expert. In fact, all of my money, except for a small gambling lottery ticket on SPXS, which looks very good right now for Monday, is absolutely on the focus of what's been going on. What is going on? Well, let's talk about the tariffs. I'm not going to talk about the absurdity of the tariffs. This is the stupidest thing I've ever seen in my life. When you look at the formula, you look at the calculations, you look at the dumbasses who created this. I actually thought, wow, the president hired professionals. He didn't make the same mistakes as the first term. He actually brought in people who knew what the F they were doing. No mincing of words there. No apology. So let's take a look at some of the tariffs by nation, because after all, these nations are the biggest offenders and got some of the bigger tariffs. You ever heard of the nation of Lesotho? Unless you're a ham radio operator or shortwave fan like myself, you probably don't have a damn clue where Lesotho is. I'll just give you some statistic. We import $256 million per year, primarily in diamonds, a little bit of gold, some textiles, and a few other metals. It's not really a big country. It's about as landlocked as it can get in South Africa. They have a tribal king, and it's not very big. The average earnings there for 56.2% of the population is $3.65 per day. Now, believe it or not, this poor little landlocked country only imported $7 million from the United States of America. How dare they? How dare those people didn't save $3 of that $3.65 for an F-250 Super Duty? We imposed a 50% tariff because the numbers look bad in the calculation algorithm. A 50% tariff on a country that, if the tariff was zero both ways, zero, they couldn't afford to buy anything this nation makes. Not even a Donald J. Trump Memorial Medallion. So let's go on from there. Let's pick on another country. You guys have no clue where Saint-Pierre Miquelon is. Let me get my nasal French accent going. Ho ho! Le Saint-Pierre Miquelon. We imposed a 99% tariff on these people. It's a small island off Newfoundland. Ho ho ho! We are very French. We are a French territory. 99% tariff. Population 5,800. 5,800 people. They had the daring, just absolutely obscene idea of not importing one damn thing from our country last year. However, they did export $3.5 million. Oh, well, we exported what you asked for. And we have no room because we have no expressways. So what would we do with the F-250s? Yes? See? May we? C is the Spanish problem. I'll talk about that some other time. So we put a 99% tariff on it because the quote-unquote formula for fairness from this president. So the population of 5,800 people exported what? Well, in the 20s, it was booze. It was a stopping point for smugglers from Europe, bringing booze in during Prohibition. Last year, it was lobsters. They had a great lobster season. Wow, shocking, huh? But we gave them a 99% tariff. That'll show you the son of a bitches in the American colonies shall pay more for our lobsters. Now, if I'm sitting in an island of 5,800 people, which has no manufacturing, has winter 8 months out of the year, and doesn't really have any viable worth as far as capitalist innovation and stuff, how damn hell would they give a crap if there's a 99% tariff? So the poor people, let's just dispel this freaking myth, especially Vietnam, before I bring in all our guests, because we have a whole bunch of guests. And I'll do the market update before I finish this. We're going to cut a deal with Vietnam. Okay, let me ask you guys a question, and I'll let our guest answer this also. How many people actually sit there and think that cutting a 0% tariff exchange deal with Vietnam is going to take some poor son of a bitch who lives on a rice paddy and craps in his backyard and inspire him to buy an iPhone? I would say that number would be zero, especially since they're just happy to be able to cut their rice down in the rice paddy, get a little percentage of that from their socialist government, and perhaps even maybe buy one pair of shoes per year. The insanity of the morons who came up with this tariff plan is on display. And I really thought the adults were in charge. And apparently so did Scott Bessent, because the disgust in his voice on financial television today was something else. So before I go into the market update, which I guess I should look at it real quick because it has been going crazy. I watched a lot of financial TV. I listened to a lot of it today. I had meetings with salespeople I've never seen before because contractors aren't buying jack squat down here in Sarasota. Everyone's scared to death. The financial people on the bubble visions, Bloomberg, Fox, and CNBC, suddenly all look like they've aged about 20 years in the last 2 days. I wonder why. The Dow was down 31.07 to 38,314. Oh, we lost 40,000. No big deal. The NASDAQ down 962.82 to 15,587.79. The NASDAQ composite, that is. Wow, looks bad. The S&P 500, that's a beauty. Down 322.44 to 507.4.08. If you've been reading and following JohnGaltFLA.com and MacroEdge.net, I've maintained that we will see 4,800 a lot sooner than we thought. So far, that forecast stands and is accurate. And I think we hit that on Monday, depending on what happens this weekend. The Russell 2000 down 80.39 to 1830.16. It rallied off the lows, which just proves retail is still full of dumbasses and bag holders. The VIX up 12.19 to 42.21. Volume starting to look like a real bear market. However, Brent wasn't what we thought. We got 10 to 1 on the New York Stock Exchange, down versus up. Good sign of capitulation. New highs, new lows, 15 versus 1036. Advanced decline, 236 versus 2598. Looks like the New York Stock Exchange capitulated. Or did the markets capitulate? NASDAQ, 688 to 3785 AD. That's not 10 to 1. 29 new highs, 1442 new lows, about 9.9 billion shares traded. It's still settling. 8 to 1 volume. Well, 7.5 to 1 volume. We haven't hit any of the depths of despair levels for me to sit there and call this a capitulation, because retail is still going out there on social media and network television, and according to JP Morgan, buying $4.7 billion worth of stock yesterday in the depths of a hurricane. These are the same morons that you see out jogging during a hurricane thinking, that's only a Cat 4, what could happen? Everyone's lost their damn minds, and be prepared for a lot of pain, because you're going to hear a lot of whining and a lot of justification for people staying long in the garbage that has been a fraudulently Federal Reserve inspired monetary market. Moving on, gold down 63.84, silver down 226. WTI crude down 408. Now everybody's saying, oh, it's because of this. It's because of the the tariffs. We're going to make America great again. No, that's called demand destruction, you idiots. Demand destruction. And it's a deflationary thing that occurs after, I repeat, an inflationary surge during a tariff cycle. Brent down 367 to 66.47. Copper down 42 cents to 441. Bitcoin actually held its value. I'm impressed. Up 1896 to 83,858. People have lost their damn minds, but God bless them. If they want to invest in it, I'm not going to tell anybody they're off their rocker. I'm not going to criticize them. Go ahead and have a good day. 10-year, 3.998. 2-year, 3.672. 10.33 unchanged after drastic moves this morning. 10s threes was down a negative 0.34. Now it's only a negative 0.27. Buckle up, folks. It's about to get wild. So tonight we have Melody Wright, Nobody Special, 6, Greg from the Coastal Journal, and a full slate to talk about markets, tariffs, and shut me up with my rants. Let's start with our friend, Nobody Special. Sir, how you doing this evening?
I'm doing great, John. And I had all kinds of things planned that I was going to say, and I completely lost my composure as soon as your French accent rolled out. So I have no idea what I'm going to do now. I'm totally unnerved by that.
Well, bonjour, monsieur. Welcome aboard.
Well, it's been a hell of a day. I'm kind of with you here, in shock. I think there was all this optimism this week. CNBC was saying buy the dip earlier this week. And in particular, Wednesday afternoon, everybody was floating around this rumor about the 10% baseline tariff. And, it's not going to be as bad as everybody thought. And it was this default to blind optimism that I've seen run rampant in this Fed-induced everything bubble. And then, of course, we got the announcement Wednesday night, and it was, as you so eloquently described, and the market just freaked out, and it was really something of a reality check. And look, these tariffs, they're nuts, as you point out. I'm not even going to go down that road about how crazy they are. And they're hitting at a time where everything is priced beyond absolute perfection, priced for insanity. This is just a powder keg here, and the price action for the last 2 days reflects it.
So we're seeing bubbles explode. I had to stand up. I had to get out of my office chair so it doesn't squeak. I had to stand up and proceed on to my next rant. So the high-tech AI super duper bubble apparently has popped, but we see zero coverage on financial media, on the mainstream media, or the fact that NVIDIA has cratered below $100 per share. So please introduce our audience to the fun and games of CoreWeave and NVIDIA and the BS that they've been pushing on the markets, and how bad that's going to hit when people realize it's in their 401ks.
I first caught wind of this company in August of 2023 when I realized that line of credit that CoreWeave had taken out from Blackstone and a consortium of other companies, this $2.3 billion loan, matched exactly NVIDIA's data center revenue beat in that quarter. It's almost like they just manufactured an earnings beat. And that was my first thing I was wondering about. And then I look into the history of this company. I'm like, oh, they used to be crypto miners. Well, that's a little sketchy. Oh, they used to run a hedge fund. That's a little sketchy. And then I find, oh, they used to run carbon credits through shell companies in the Cayman Islands. That's sketchy as all get out. It's not outright illegal.
Geez Louise, folks, we apologize for the interruption, but apparently Jensen Huang absolutely has something on Elon Musk. We're bringing everybody back up. I apologize for this break in the conversation. I had Melody getting ready to talk. She's going to be back on here in about 30 seconds. Then we're going to bring nobody special back on here. Well, I thought I was going to bring. There she is. Yeah, she's back on. Melody, you there?
I am here. Can you hear me okay?
You sound much better. Apparently, we were routed through China and they cut us off. Please finish your thought, because you and I both had the same theory, and both of us sadly went through the 06, 09 fiasco. Remind everybody about credit materials being used for building, and just what the impact of a stock market crash, commodity problems, and import problems might just have on housing. And that's before the FHA fraud comes out.
Yeah. And so let me start with data, John, from just conversations I've had today with family members and friends, one of which a boomer who probably leans left and essentially has said, that she's going to buy the dip because she's seen this time and time again, and she doesn't have a lot of time left. She's down over $300,000 right now. And so, I want everyone to kind of take that into consideration, that there is just, like you're saying, John, I don't think there's any capitulation out there. Retail is very misinformed about the fundamentals of the market. And so, we are on a lot shakier ground than people think. So let's transition over to credit and mortgage. So some great work, and I'm gonna have I'm gonna be interviewing some folks on my YouTube, but we have now, the Fed has come out with a kind of deep dive into what did sort of that non-reporting of student loans do to credit scores. And I highly recommend everyone check that out, because there were massive impacts, as we've been talking about all along. We knew that credit scores were inflated, which means that your Fannie Freddie books are much more vulnerable than most people think. We know about the issues in FHA because that's the lower end of the borrower. That's the 580, 620 credit score, 3.5% down, no skin in the game. And often that 3.5% down is met with down payment assistance programs, so which are being shut down. So Pulte recently announced that all of their special credit programs, like that down payment assistance, buy downs, etc., are being shut down. Now, this wasn't a huge program, but it's meaningful because of what it shows the shift in narrative. And so we already have deep distress on FHA. But what I'm here to tell you, based on what I've seen in mortgage books today, as well as what I witnessed in the last crisis, is that when I was sitting in FP&A at a top 5 originator and servicer in 2006, credit quality looked fantastic, and it then just proceeded to deteriorate. In fact, FHA delinquency peaked in 2005. This is what a lot of people don't remember. And that was, at the time, only 7% of outstanding mortgages. Today, it's between 13 to 15%. It goes back and forth depending on origination, as well as non-performing loan sales that no one ever thinks about. And so this is a big deal that we're over 13% delinquent in that portfolio. At the same time, we're delinquent in privates, which are about 3% of the market, over 12% delinquent. We are also at almost a 5% delinquency rate in VA, which is another 3 to 5% of the market. You add all that up, it's 22% of the market that is in serious trouble. And now that we have this impact from not only the student loans becoming due again, but Affirm is about to start credit reporting for buy now, pay later. I know this courtesy of Danielle DiMartina Booth. And so that credit quality is degrading at a rate much faster than I think people could have anticipated, as well as we are seeing the Fed just put out their survey of consumer expectations. They have two parts of that series: one, the expectations, one, the experience. And in February of 2025, 41.8% of refinance mortgage applications were rejected.
Well, now that brings up another question for you, because right now everyone looks at credit from the applicant's point of view and the deterioration of existing homeowners who probably shouldn't have gone into 30-year mortgages, another subject that you and I have discussed frequently. But a lot of people don't understand that the smaller builders also use credit and borrow a buttload of money from regional and community banks to build spec homes and buy properties, which now all of a sudden, despite the fact that we have lower 10-year yields, which President Trump and Bessent pounded the table on, whoops, what happens when people can't afford to buy a new home? Please remind everyone.
Well, so John, the builders as well as the non-banks, okay, and so yes, everybody, that the builders live on big credit facilities. The big builders, the small regionals, like you say, actually rely on those smaller institutions. And so, one of the things that I just kept having to say to people in 23, Zonda, all those folks that were saying they tracked every single new home built out there. When I went on the road, it was very obvious to me they didn't. It was very obvious that they tracked the nationals and the large regionals, but not the small and privates. And it's really as if no one talked to one another, and they never even came out to the site. They just let their foreign-born workers build there and be managers there without realizing that right down the road there was another new build subdivision. And I'm not kidding around. You can go to Round Rock, Texas, and it's the most bizarre thing I've ever seen. And so, to your point, these small regional builders are imploding left, right, and center. Back last year, Travis and I went to Austin. We have footage of a abandoned new build site, which at the time, people told me it was a reputable company, but, nothing's happened to that site since. So to your point, these folks, small regional banks, are going to be hit very hard from both these new builds and, a lot of them hold commercial real estate exposure as well.
Well, let's go to the next big subject before I switch back to Nobody Special, because this is huge, and I don't think people understand this. Everybody is focused on the small regional banks, the small community banks. Let's go to the next subject. And the word and the phrase that a lot of people are ignoring, because the masses, and let's face reality, when I speak of the masses, I'm talking about all of these quote unquote Reddit investors and CNBC pump and dumpers are not paying attention to, and that's the phrase NBFI, non-bank financial institutions. The bank loaned a god awful amount of money to these idiots, saying, you know what you're doing.
Yeah.
However, in housing, that's not necessarily true. And in commercial real estate, which I'm sure that if Mr. Austin were here, he would go on an hour-long rant about that. That's very much so not true. So when the NBFIs have to start reporting their defaults through the banks, what are the consequences for residential lending, in your opinion?
Massive, John. And, I encourage everyone who has this bent, this research bent, to go look at one of the 10Qs and look at the debt maturity schedules. So as a lot of people are sort of celebrating the Rocket and Mr. Cooper proposed merger, what they don't understand, these are two entities very heavily invested in FHA, who are about to get just smacked down. And Mr. Cooper already, they have a very aggressive debt maturity schedule next year, but they've already terminated, they said, I think it was probably terminated on them, a large MSR, mortgage servicing right facility. So guys, so my company was the only non-bank in the last crisis that was a top 5 mortgage originator and servicer. We were the only non-bank included in the AG settlement and in the consent orders. We later became a bank, but we were not a bank. And we went heavily into FHA in 2009 because when you originate FHA, you get a significant bump on the upfront in the gain on sale. So when you sell that loan to the agencies, you get more money than if you sold a Fannie and Freddie. And so at the time, my CEO thought this would help. We would get out of the subprime crisis. Around 2007, our subprime exposure was about 12%. So think about that number when you think about the 15% of the outstanding mortgage market that I just mentioned. And we thought, well, we'll go into government lending because that is backed by explicitly by that government guarantee. But what we didn't understand is the government is like every insurance company, and they slow roll those payments, and liquidity becomes a huge issue. And then you're trying to then pledge assets. You then trigger covenants, and so these guys, these non-banks, are about to become very beholden to the big banks, and the big banks are also going to suffer at the same time for giving credit to these guys. I mean, this is just getting started, and because of those rate moves down, the mortgage servicing rights at that big asset at all of these organizations, which is what saved them in Q4, that is going to be written down because of those rate moves down. So, John, it is one big mess, and the big banks are not immune.
That brings me to my favorite big bank, and also Chris Whalen's, by the way. And this will be your big question as we close out and head over to Nobody Special, who I've got to rewind because I don't think he really has a lot to say about NVIDIA and CoreWeave. There's a certain large American bank which has decided that subprime loans don't exist, and they never thought that we would downgrade the FICO scores on all of these student loans and gave money to every idiot that could fog a mirror, citizen or non-citizen. Now, I'm not going to mention that bank by name, but their symbol is a BAC. When you start looking at the CLO and CDO and other derivative extracts on that, isn't the problem far worse for these big banks than advertised?
100%. And let me just tell you, so when Cerberus bought ResCap, GMAC ResCap, back then, guess who they instilled as leadership around 2010? It was former Bank of America execs. And I remember being on the executive floor in the GM building in New York right before we announced earnings. At the time, we weren't sure. This was probably 2009. We weren't sure we were going to announce a ResCap bankruptcy or we were going to announce a bailout. And all of those execs that came formerly from Bank of America, we were all on the floor, and one of them was talking about, what we used to do with securitizations. I mean, we just look at what we thought month end was going to end at, and then we would just pile up a whole bunch of stuff and just sell it, and we wouldn't even really look at it. And they admitted that. Whereas what was so funny is my company was known as a subprime lender, but we were actually very conservative. So I have no respect for that organization, John. And clearly, because they were too big to jail, they never learned their lesson.
Melody, thank you for your time. And if you missed her show a few weeks, don't miss the show that we did. Go to macroedge.net or MacroEdge at MacroEdge RES on X. You can find the show there. Folks, you can read her information on her Substack. You can read her writings on the real estate platform. But macroedge.net / boy, you're going to need this. MacroEdge.net for a 2-week free trial. This is insane what is going on right now. And we are really having a major issue, folks, with X tonight. So if you can hear us, God bless you. This is not our speakers. We thought at first it was just telephone connections, etc. It's not. It's a problem with X. We don't know what's causing it. We're going to try and fight through this. There's no reason to sit there and think otherwise. But go to macroedge.net, get the 2-week free trial. Let's go on to Nobody Special. Mr. Nuke, please let us know. Were we just exaggerating about the problems with our friends at CoreWeave and NVIDIA? Or could this actually be a major problem, not just for hedge funds, but for 401ks, mutual funds, and idiots who believed everything these people spoke about?
John, before the meltdown this week, the AI bubble was $17 trillion. And I arrive at that number because that's basically the market cap that's been added to the S&P 500 since ChatGPT was released. 17 trillion with a T. And it's almost exclusively been in the Mag 7, all of which have rallied because of the AI mania. So I don't know who's immune from 17 trillion unwinding. I don't think there's anybody out there that's immune from this bubble bursting. It's that big. And I don't think I'm being excessively doomy in saying that. Now, look, with CoreWeave in particular, CoreWeave is not the entirety of the AI bubble. CoreWeave's a relatively small company, but CoreWeave is a microcosm of what this entire bubble entails. And my initial assessment of CoreWeave, based on 5 minutes of Googling in August of 2023, and I find their the stuff I mentioned before we got cut off, their crypto history, a little shady. It looked like round tripping revenue, little shady. And they're like, oh my God, shell companies in the Cayman Islands trading carbon credits, not illegal, but you know what? That's something a lot of criminals do too. Interpol warned us about it. And I said, you know what? CoreWeave is a questionable company. And I was so wrong, John. I was so wrong about that. After 2 years, I'll admit I was wrong about CoreWeave being questionable. CoreWeave is not questionable. CoreWeave is outright financial degeneracy. It is a ticking time bomb, a landmine that has been created by a hedge fund with a reputation for creating landmines for retail traders to step on. And they got away with it in the GFC, and they're doing it again. And they cashed out, and they have created this Frankenstein that is designed to fail. And they have positioned themselves so that they make money. If it fails, they make money. If it doesn't fail, either way, Magnetar gets paid and retail gets hosed. And I know this because I committed the cardinal sin. I didn't just watch CEOs signing boobies and buy stock. I actually opened up the SEC filings and read what this company is telling us. Oh my God, that S1 filing from CoreWeave is, I dare you to buy this stock. That's what it's saying. I double dog dare you to buy this stock. Now, I'm going to get into some numbers here, and we're going to get progressively more degenerate as we go through this stuff. Cut me off at any time if I lose you or jump in, or if you need me to elaborate on anything. But starting simply with the financials. 2024, $1.9 billion in revenue. Oh my God, 700% year over year growth. Our growth is ecstatic. The demand is insane. That's the cover story. But you know what? After 1.9 billion in revenue, they still lost $863 million. Nowhere near profitable. All right. And on top of that, they're $8 billion in debt. Now let's talk about that debt. The first is that $2.3 billion line of credit, fully drawn, the one that first I picked up their scent back in August of 2023. That's got a 14.1% interest rate attached to it. That's costing them $892 million a year in interest expense. Remember, their entire revenue, $1.9 billion. So just that one loan, $892 million a year in interest. Their other loan, the $7.6 billion loan that they took out last year, $3.8 billion of that has been drawn down. 10.5% interest they're paying on that. That's costing them $760 million a year right now. And by the way, if they ever fully draw that, which they're almost guaranteed to do, the interest expense on that loan will be $1.5 billion per year. This company.
So, real quick question. How much of that is private equity and how much of that is actual financial institutions? Or do you have that information ready at hand?
I know about 500 million of it was Magnetar lent it. I know Blackstone, Kochu was a big player. All their major shareholders are also their major debt holders. And I can't tell you for sure which pension funds, but I know at least one pension fund in Canada has invested in this. I don't know off the top of my head which one it is or what the dollar amount is. But we're talking over 8 billion in debt here. This is spread pretty far and wide. Now, the other thing to keep in mind is this debt, this company is propping up this bubble. So even if pensions aren't directly exposed to CoreWeave stock, they are directly exposed to the bubble created by this company. Right, so the debt alone is enough to kill this company. I mean, it's unbelievable how much they owe. But the other thing is depreciation. They took all this debt, they borrowed all this money, and they bought GPUs with it. All right. 2024, their depreciation expense was $863 million. I mean, look at these expenses, just interest and depreciation alone right there, more than their revenue. And we haven't paid anybody yet. We haven't paid rent on the data centers that they don't own, by the way. They rent those. There's no path to profitability here. And that $863 million of depreciation is on a 6-year depreciation cycle for those GPUs. That's obscene. I mean, your computer, imagine if you ran your computer 24/7. Do you think it's going to last 6 years? And I don't know about you, but I don't think consumer electronics are stressed nearly as much as data centers that run 24/7, overclocked with all the heat that they generate. There's no way this stuff is going to last 6 years. So their depreciation expenses are only going to go up. On top of their depreciation expenses, the H100s, which makes up the lion's share of their GPUs that they bought, that also is collateral for their loans, by the way. Tag me on that. They use rapidly depreciating assets as collateral for loans. Okay, let's gloss right over that. The rental rate for an H100 at the beginning of 2024 was $5 an hour. Today, it's $1.90. So their revenue is not going to go up, at least not on a per GPU basis, and they've already taken out $8 billion to buy them. How are they going to scale up here? The financials of this company look horrible. Now let's also talk.
So I'm gonna
Go ahead.
Let me interrupt you real quick. I hate to say it, but my PC is 10 years old and I built it myself, so maybe there's a difference there. But on a more serious note, I've been to the large rack farms, and something that's not taken into account is that a lot of the internal components for those racks, I know this is going to come as a shock to Peter Navarro, are not made in America and are imported in. So if CoreWeave and NVIDIA are so far behind on deliveries, which they've already said they're way behind on the 200s and 300s, how bad is this situation going to get when you add a 30% surcharge on not just chips, but believe it or not, people, this is something that's going to shock you. There's capacitors, there's resistors, there's circuit boards, and they're not made in America. Please elaborate, sir.
Well, they're not going to get cheaper, are they, John? They're certainly not going to get cheaper. Now,
not in a billion years.
And we still don't know, by the way, what the semiconductor tariffs are going to be, because they were exempt from what was announced. So, there's estimates being thrown out. There's guesses. It's going to be 10%. It's going to be 25%. If Wednesday night is any indicator, whatever the semiconductor tariffs are going to be, they're going to be worse than we thought. So, yeah, there's that. That's not going to help NVIDIA's sales, that's for sure, especially not as their biggest customers are starting to pull back their data center build-outs. Now, CoreWeave likes to brag about their contracted capacity that they say, oh, we've got 1.3 gigawatts of capacity that's under contract. Well, they've only actually built 360 megawatts of that capacity, and they spent $11.5 billion to do it in the last 2 years. So just based on some quick math, pre-tariff math, mind you, it's going to cost them about another $39 billion in CapEx to build out this additional gigawatt of data center capacity that they're bragging about being contracted. And by the way, it's contracted with companies that don't make a profit. So how are these companies going to pay for that contracted capacity, especially if investor cash starts to dry up? That's a whole other question. Now, who's going to build that capacity? They signed a deal with Core Scientific. Anybody ever heard of Core Scientific? That's a Bitcoin miner. Core Scientific went public via SPAC in 2022. They went bankrupt a year later in 2023, and then they went public again in 2024. And now they're going to build a gigawatt of CoreWeave's data centers. They've never built high-performance compute, by the way. They've only ever built Bitcoin miners. Good freaking luck getting those data centers built with that company that is just known for robbing people. Now, their biggest customers, Microsoft, and the S1 filing let this one slip. 62% of their 22-24 revenue came from Microsoft, who has just told us, we learned this week from Bloomberg, that TD Cowen was right. Microsoft is scaling back their data center build-out plans. So 62% of their revenue comes from one customer who's slowly walking away from this business, or at least not diving in anymore. Their second biggest customer, this is fun, NVIDIA. Their biggest supplier is their second biggest customer, is also a shareholder, owns 6% of the company, and also just bailed out their IPO. They had to anchor the IPO 24 hours before they went public. They reduced the size, they reduced the share price, and NVIDIA has to guarantee $250 million to keep the price over 40. And by the way, they used every penny of it because the stock closed at 40.00 on its IPO day. So just for a minute.
So who's the idiots buying the bonds? That's my bigger question. Who are the morons investing in bonds who think they're going to get something out of this if this company goes tango uniform? For those of you who are not familiar, that's a financial term for tits up. Go ahead, sir.
Well, the thing is, Magnetar is the biggest one, and Magnetar has written this book. They've taken over this company so that Magnetar eats first, no matter what. And that is how Magnetar has always operated. Now, the money moving around in circles, NVIDIA makes an investment in CoreWeave. CoreWeave takes that money, buys NVIDIA's chips. NVIDIA rents those chips back from CoreWeave, and then NVIDIA gives more money to CoreWeave to bail out their IPO. This money is getting dizzy. It's going around in circles. It's creating the illusion of organic revenue. And, you know, as Daniel Attia, he's a venture capitalist, just wrote in a very good Substack article about this company. He called this Enron with GPUs. Gil Loria, an analyst at D.A. Davidson, comes out and he says, CoreWeave looks like a special purpose vehicle for NVIDIA, an off-balance sheet arrangement to amplify a $350 million investment into a $10 billion customer. That's not Twitter rando conspiracy theorist Jack on YouTube. That's an analyst at D.A. Davidson. All right. And by the way, they all said I was crazy for even suggesting this crap was going on 2 years ago. And now they're all saying the same thing.
Well, if it wasn't for you, Greg, over at Coastal Journal, Just Dario, and Kalashi, I would have no clue about this. So I'm going to bring up the next question, sir. And God bless you guys for doing all the work. Your YouTube videos, and if you haven't looked, Nobody Special makes a great series of YouTube videos, including some with Melody Wright and Travis about real estate. Must see TV. But I'm going to ask you a question on two parts. One, does this or does this not feel like the speculative bubble from 2000 rephrased, repackaged, and saying, hey, look, we got more sophisticated financial tools. Let's take a crap on the average investor. And number two, what's your opinion on the consequences of this NASDAQ speculative bubble? I don't see a happy ending.
No, there's no happy ending. And I'll be honest with you, John, I tried to warn people back in 2023. And let's be honest, I failed because this bubble never should have inflated as big as it did. And the fact that it did, and these guys have already cashed out, so they've already made their money at our expense. It's too late to stop it. And I'm very sad to say it because it sucks. Because I saw them doing it and I was screaming it from the rooftop and I couldn't stop it. What Magnetar has done is the 2000 dot-com bubble, right? The creative vendor financing, round tripping, whatever you want to say. But it's also exactly what they did in the housing crash too. And Magnetar is famous for the Magnetar trade. And this is one of the first things I made a video about. The first thing that kind of went viral on this subject was I pointed out how Magnetar, if you haven't heard this history, during the GFC, that whole scene in The Big Short at the sushi restaurant with the Asian guy and Steve Carell's hair is all messed up because he can't believe what a POS this guy is. That was the Magnetar trade that he was talking about. That guy's name was Wing Lao, I think was his name, Wing Chao. And he worked for Merrill Lynch, but he was working with Magnetar. Magnetar was handpicking the CDOs that had the worst, or handpicking the mortgage bonds with the highest delinquency rate, with the highest credit risk. And they were telling Wing Chao what to put into the CDOs to make those CDOs more likely to fail. And then Wing Chao went and sold them to unsuspecting investors, and Magnetar bet against them failing. And Magnetar's CDOs had a 95% failure rate versus the industry average, which was about 60 during the GFC. So that's all fancy financial talk for Magnetar created intentionally sabotaged investments to sell to unsuspecting investors while betting on their failure. That's who we're up against here. And they have done the same exact thing with CoreWeave. They have created a company designed to fail and set it up so they profit either way. Magnetar owns 30 million shares from the Series C offering. They own about 35% of the company. Within 2 years, Magnetar can demand CoreWeave buy those shares back for them at $38.95 a share. Even if the stock goes to zero, CoreWeave still has to buy those shares back from Magnetar for $1.2 billion. So if Magnetar engineers the failure of this company, they profit.
So here comes the final question, sir, because we're going to be talking markets, and I'd like your take on this because you've been offering some great commentary in the mornings. He's on 9 a.m. every morning on X. If you're not following him, he's at JG Nuke. And this is really important. People are looking at the flash bang of AI. Suddenly, the AI trade went silent this week. And the realization is, especially with the terrifying news from Microsoft today, that their quote unquote agent can impersonate you and make purchases for you that you were going to intend to make. What could go wrong there? As this crash accelerates, because folks, I'm telling you right now, Kramer just mentioned 1987. That son of a bitch was part of the fraud back then, but we won't talk about that. What is your biggest fear heading into the next couple of weeks? Because the tariff wars are one thing, but the pain that most people under the age of 50, and you're probably a lot younger than I am, as everybody else is, has never been experienced before in a true bear market. What is your biggest fear for the tech people? Are they going to get scared and pull their financing back? We've already seen a lot of IPOs pulled back. Finish off your conversation with, and tech all the time you want, how bad, in your opinion, is this going to get for private equity, for investment in high tech, and what the future holds?
Well, private equity is already pivoting. The CoreWeave IPO was a CF, to put it mildly. And Klarna just canceled their IPO. So the message to private equity is find somewhere else to dump your bags. And they've already started. Did you see the article about how Larry Fink wants to democratize finance by making private investments available to the average person? They want to park this crap.
That son of a bitch wants to socialize losses just like the assholes who did derivatives in 2007.
Bingo. That's exactly what they're doing. So they're going to use retirements for exit liquidity, or at least they're trying like hell. So that is my biggest fear, is that happens. And let me just tell you, that politically, you can sell that. All right. If you can delay the crash a little bit longer and you can park all of this crap like they've done with commercial real estate and MBS and everything else, if you can park all this crap in the pension funds, then the bailout has already happened and people don't even realize it, because they've already walked and now they're holding the bag. And you're guaranteed they'll bail out the pension funds, right? When the pension funds start failing, they're not going to let grandma go broke. I'm like, that politically, that's untenable. So they'll spin up the money printers and they'll bail out the pension funds. They'll buy all these crap assets, park them on the Fed's balance sheet, create a whole bunch more money, add to the consumer inflation problem. And they won't realize the reason this bailout is even necessary is because Silicon Valley and Wall Street conspired in 2022 when they needed a shiny new thing. The market was selling off, and they created the AI bubble out of thin air. They took a technology that's neat, that can do cool new things, and might eventually be profitable. It's not going away. But they created this out of thin air, and they robbed everybody. And I tried to warn people. It didn't work. It's too late, John. It's already been done.
Melody and I can feel your pain because we both tried to warn everybody in 2006, and we were told we were insane. And I spent 2 years on the radio in 07, 08 trying to warn everyone. So, sir, don't
John,
feel
I'm
like
sorry.
It's your failure.
Could I give you? I need one more minute.
Go ahead, sir. No, you can rock and roll. Go ahead. Your time is my time.
Because the thing I got, again, with Magnetar, what they've done, all right? Magnetar created this Magnetar AI Ventures Fund, a $235 million fund that they raised. All right. CoreWeave invested $50 million into this fund. Now, CoreWeave got that $50 million from Magnetar to begin with. Then Magnetar gave the entire fund, $230 million of it, in the form of a refundable deposit to CoreWeave for future compute services. So CoreWeave reported $230 million of revenue that was really a loan from one of their shareholders. And that loan was made up of partially their own money, which they already got from that shareholder. That same dollar traded hands back and forth between those two people 4 times. Now, Magnetar can demand repayment of that $230 million with 72% interest at any time. And they hid this in the S1 filing by changing the name of the fund. In one section, they refer to it as the Magnetar AI Ventures Fund. And in the other section, they refer to it as the MAIV Fund. That's not an accident. That is what sleazeballs these CoreWeave people are. They're hiding it, thinking we won't notice because, well, nobody reads this stuff. Magnetar can also demand repayment if CoreWeave's revenue slips on that $7 billion loan that they've taken out. And oh, by the way, CoreWeave has already defaulted on that loan because they spent the money in Europe when there's a covenant that says you got to spend the money in the United States. Was that an accident? Did these tech visionaries that Jim Cramer says are the brightest people on the face of the earth accidentally not catch something that an entry-level paralegal would have caught in the fine print of their multi-billion-dollar loan? No, they didn't. Magnetar has engineered this thing so that no matter what, when this company fails, and it is mathematically guaranteed to happen, Magnetar gets everything. They get the GPUs, they get the cash, they get their shares automatically bought back. The retail bag holders that are buying this crap will end up with nothing.
It's absolutely awesome assessment, sir.
All right, that's it. Nobody special. I'm shorting it.
Go ahead, Six. But real quick, nobody special. Promote your show. Promote your daily show at 9 a.m. Promote everything else. And by the way, thank you for your hard work because you and I are one of those some of those few freaks. Well, Six is too, and a lot of the people here at MacroEdge. We actually read 10Qs and quarterly reports. And guess what, folks? You find out things that are somewhat important if you actually read the details. And what you're good, if you actually did what we did, you'd be scared as hell going into next week. Go ahead, sir.
Well, the one thing I haven't read is whatever Jensen wrote on that woman's chest, but I'm willing to take a look if she is. But beyond that, my morning show every morning at 9 a.m., every business day, we go through markets, we do the news of the day, and then periodically I do these investigative pieces like I did with CoreWeave. And that's at Nobody Special Finance on YouTube, and of course, JG Nuke at Twitter.
Nobody Special, thank you so much. Now we're going to bring Greg Crennan up because Six is in the waiting and he's stuck in traffic, so he can hang on a little longer. The Coastal Journal, the Punisher, the man who also contributed to the insanity known as the CoreWeave, don't get me started on NVIDIA, and warning people religiously of how stupid our markets are behaving. Greg, please go ahead. What do you make of the markets the last 5 days?
Hey, John, thank you for having me, and thank you to the audience and for listening. There's a lot going on, and so, I want to put out as much valuable information in a short period of time that we have this afternoon. And so going straight into the markets, I was actually dealing with some clients today, and they were asking, when is a good time to start buying? Let's put some actionable use here on what's going on. And when I said, well, prices are down pretty significantly since February, that doesn't mean that the values of the companies, which they are down, are not even they're still in the atmosphere. They haven't even come crashing down yet. They've come down, but they haven't come crashing down yet. And so when you're looking at companies, I'll just name a few off the bat because I had them on my list here. When you look at companies like AMD, it's still trading at 80 times earnings. And that's for all these earnings that I'm multiples that I'm listing off are all current, not forward. And just to give you the audience here, a difference between forward and current earnings is because a lot of times media will say forward earnings because they want to pump the stock and they're just being very enthusiastic that companies will continue to grow earnings. So if companies grow revenues and grow profits, that means their multiples will actually come down in the future. So when they say their forward multiple is lower, they're assuming that companies' profits and revenues are going to rise in the future, which then brings down their current valuations. But I like to go off their current valuations because that is what the actual revenues, streams, and profit streams are on a company, and that future forward multiples are a lot more speculative. And so these following valuations are still in the atmosphere. And so you look at companies like the semiconductors, AMD is trading at 80 times earnings. You look at Tesla is still trading at like 120 times earnings. You look at even the other Mag 7 companies like Apple's in the 30s, Amazon's in the 30s. And so you're still paying an astronomically high valuation for future earnings, which is future profits and revenues. That now that the data is being more clear that the economy is slowing, and now that we have the Trump trade wars escalating globally, that those tariffs are going to hit margins like Apple, that you're going to get a less return on the shares that you own today. And so, when looking at when to start buying, one, I would absolutely not even touch anything right now until after this earnings season, which kicks off next Friday. And then once we get into, like you mentioned, get into some 10Qs, get the corporate guidance, but it's not going to be pretty, especially as these tariffs immediately start to cut into margins and valuations are nowhere even near what the market multiple is, which is still trading around after today's sell-off, probably around mid 20s, maybe 24, 25. I don't have it off the top of my head right here. Now I'll let you throw in a question since I got
Well,
started there.
I'm gonna throw. That's okay, man. You're doing fantastic because people need this feeling. I actually talked to 3 people today, 2 of my neighbors, another stupid salesman who I've never seen before, trying to sit there and sell me stuff. I said, look, just because your contractor's bailed, I don't need it. But they all had the same complaint. My 401k is in the tank. Now, most people view investing as their 401k, but they don't understand that a 401k is a group of stocks, bonds, et cetera, compiled and created by some computer, not a real human being, and then put into form. And you can verify this for our audience. If for those who are not experienced, unless you got 9 figures in your bank account, none of the brokerage houses give one shit, not mincing that word, shit, shit about you. They don't care. They won't take you live on the air. They won't take your phone call. And when the markets really begin to crater, which I think is Monday, 5% isn't jack squat. But when the markets really begin to crater, you're an afterthought. Fill in our audience about the reality of what happens during a major market event.
Yeah. Well, it'll just be mass selling. There's no bids when that comes. And so what happens is when the market goes down and there's no buyers, the market will just continue to free fall. Now, I'm going to throw a twist. I did a piece for the Coastal Journal last year on when the 0-day options expirations became popular, the ODD bubble. And now what this did was, and this is actually interesting because of thanks to MacroEdge and just sending me that it looks like we're now on the NASDAQ back to, or on the QQQ back to 2021 price levels, or near within a couple of percentage points. And which means that all of last year's gains have now been erased. And when we were looking at last year's market moves at my firm and reporting for the Coastal Journal, is that the market moves when company would say release their earnings, Wall Street said they would beat. But then you would look at their earnings and you would actually see that on a year over year basis, they would either be flat or actually negative. Now, Wall Street said they beat because Wall Street, quote unquote, lowered their earnings estimates. And then no matter what their number was, it would be a quote beat. And then via the option market, you would have Wall Street bid up the stocks via these options. And then you had the market makers, because the stock prices were moving up higher, then had to make sure that the shares were available at the end of the day every day. And so that's why you would constantly see and get these, end of day squeezes, because you would have to make sure that everyone had the right and proper amount of shares for every transaction to be settled at the end of the day. And so basically last year, you had the market that was going up on thin air, which made it a bubble through derivatives, and that drove up valuations. And now those valuations are starting to come down. The issue is that things were so expensive and so overvalued that even since this recent massive decline in stock prices since February, valuations are still high. And so that froth and now is going away. And so as companies, and we'll get into earnings season here now, next Friday when the banks start reporting with JP Morgan and Bank of America. We'll get a bigger insight on how lending is going. And the only reason why they did well on earnings, the previous quarter that they reported, was that their trading houses all produced a lot of money, and that was because the stock market was going up. If you actually looked at the bank's earnings and saw that they weren't actually making money in what they do, which is create loans, was going down. And so I'm sure that based on the GDP data from the Atlanta Fed saying that GDP is negative, business sentiment is lower, that the banks probably are going to have a really bad earnings, is my guess, especially since that a lot of their money that they make is when the market goes up. And if the market goes down, they're going to have a lot of losses on a year over year basis. And so this option craze exacerbated the bubble, and we've never had zero date options before. And in other markets, like in the Europe, the DAX, the FTSE, they don't have zero date options. And so America is the only market that has zero date options that really fueled, and that's why the S&P was like, I think, the best performing overall world index last year in 2024. And that's one of the reasons why we had such a, what I would call a blow off top going into last year.
Okay, well, now I'm just going to scare the hell out of you because one of the people I follow and I've had lots of conversations with just posted an article last night. How much exposure, in your opinion, and you're doing this through a circuitous route, so I understand that, do the large financial institutions and small regional ones have to funding agreement backed notes, FABNs? A term I haven't heard until tonight. I'll be honest. When I don't know something, I will say it. But Chris Wayland yesterday wrote about another AIG risk because of insurers having to insure with derivatives a lot of the defaults from private equity, which will directly impact our banking system. Are you into this, or is this, I need to get Chris on here tomorrow? Let me know, please.
Yeah, I mean, there is absolutely. I mean, when you look at the derivatives market as a whole, I mean, there are some reports on the OCC report that shows that there's technically quadrillions in derivatives, and so I haven't looked recently on the exact exposure specifically for AIG. I just know that there's trillions, quadrillions in derivatives, and more and more keep coming out, and I wouldn't be surprised. When someone's gets holding the bag, especially if things end up continue to going south, that we're seeing.
So what you're seeing is what a lot of us saw, yourself included, in 07, 08. Everyone's so focused on earnings, 10Qs, et cetera, for the financial institutions. No one is focusing on the crap derivatives that they sponsored and financed once again. Oh, yeah, that's right. They're called bespoke investment opportunities. If you've watched The Big Short, you understand
Now,
the stupidity of that. And now
John,
we're sitting here facing the same risk.
Now, John, let me add, and for everyone paying attention here who's looking at investments and how they can look at the recent OCC quarterly derivatives report. I put out probably back in January about how the banks were actually loading up on gold derivatives contracts back in 2024. And so that quarterly report, actually, you can see what specific banks, JP Morgan, Goldman Sachs, Bank of America, Morgan Stanley, you can actually see what kind of derivatives that they were loading up. And so one of my reasons why I thought that gold was going to go extremely higher was that the banks were accumulating every quarter via gold futures contracts. And then what happened was in early of 2025 here, we've seen that they started calling in for physical gold. And that's why there was a massive influx of gold into America in Q1, is because if you look at the derivatives report, now remember, the derivatives, those are just future contracts on gold. It's not physical gold. And so a lot of people wanted their physical gold. And so we had to import from the COMEXs from overseas physical gold. And that's one of the reasons why the GDP number for the quarter is so massively negative, or part of the reason why it's so massively negative is because we imported so much gold, which offset our trade deficits for Q1. And to me, that is a huge sign on, backing up the whole thing that we're talking about, how the banks were loading up on gold, how they were positioning for it. And by the way, if you look at the OCC 2024 reports, you can see that they were accumulating gold the entire year when the prices were way lower, and no one was talking about the price of gold while they were all focusing and pumping the AI stocks last year.
So I'm going to read something to you from the National Association of Insurance Commissioners from 2015, and then I want you to take it and run with the ball because of the leverage that's been introduced into the system. Her name is Stefanie Varani. I'm not making that up. That's her name. I'm emphasizing because that's the accent they go. Shocks to insurers or institutional investors could trigger a run. Initial withdrawals could cause a panic and more withdrawals. The effect of the run depends on the availability of liquidity. Illiquidity in insured could lead to delays in payments. Delays could cause a panic in short-term funding markets. Did we or did we not see, and you were all over this like a lot of other people, panic in short-term funding markets when the 2-month, 3-month, and 6-month US T-bills blew out in Japan because Nan Chunkin couldn't fund their daily dollar obligations this week?
Yeah, that's right. So, while everyone was sleeping in America overnight this week, we had the short-term, um, as you mentioned, notes blow up, and the yields actually spiked. Like I think it was like 5.5. I think it was on the short end. I don't
Well,
remember the
we
exact, but
actually I'll tell you real quick. The
yeah,
6-month actually spiked 81 basis points. That's
right,
unheard of in a T-bill unless we have a
absolutely.
crash.
Absolutely. So, there's definitely some liquidity issues that are going on behind the scenes that we can kind of, as normal people, without being the Fed and the at the discount window, which I forgot to load up the report here to see what the discount window was over the past week. But the lending market blow up this week wouldn't actually be in the discount window report that was released today. It would be in next week's report. So next week we'll find that data out and see if the Fed came in, which my guess is probably that they did help bail someone out through the discount window to keep that calm for now.
Well, what's your forecast? Because you have been hammering this along with Nobody Special, Anybody Else, and Six, who's coming up next. And by the way, MacroEdge.net/ozone, MacroEdge /ozone. Get your 2-week free trial. I'm going to plug the hell out of this, people, because this is the most critical time for you and your investments, institutionally or individually at this time. What is your forecast for what the hell we might see Monday? Because right now, NASDAQ futures are in the toilet. Everything's in the toilet right now. And we still haven't heard the countervailing tariff reactions from Japan, Taiwan, Malaysia, Indonesia, etc. We could really see a backlash because I'm going to go with something, and and I know this for a fact, when you do business with Asian people, especially East Asia, and this is not a racist thing, so shut the hell up if you start there. I dealt a lot with Taiwan. They hate being offended. They hate being dictated to. And sometimes, like China did today, they shoot you the bird and tell you to go bleep yourself. People should be concerned because Japan and those nations I just listed control a large portion of our economy. Go ahead, sir.
Yeah, as far as very short-term calls, like a Monday call, I'm not really too keen on that. I mean, I could absolutely, the leverage and the froth of the bubble, and like one of the things that I said earlier this year was that the things were so overvalued, and I said, it's actually funny. Trump started this bubble when he was elected in 2016, and I thought it was ironic when he was elected. I said that he's going to be the one that pops the bubble with his tariffs because when he was elected, everyone ignored his tariffs, even though that he ran specifically saying exactly what he would do. He went on the Joe Rogan podcast and said, I'm going to put big, beautiful tariffs on Taiwan and on China to pay for it. And everyone dismissed that, thinking that he was crazy. He wouldn't actually do it. And he literally said exactly what he's doing. And so I don't see of that letting up. And to your point, there's going to be tons of retaliation. We already saw it today with China. Now, as far as my calls go, the overall market, companies, they're priced for growth, and not just any like a little bit of growth. They're priced for double digit and more growth. And so not only if business just stays flatline, but now with the tariffs, since most of these companies deal with companies that import goods are going to be dealing with tariffs, that's going to be cutting into some part of their business, which means that whether they pass along the cost and then demand gets crushed, they absorb the costs and then cuts into their revenues and profits. Today's prices of the market are highly overvalued and will be much lower in the future from today. I don't know how much lower, but as far as where I would be a more willing to be nibbling is when things would be trading at a more of the median or mean range that the S&P trades at. So that would be around 15 or 16 times. And only when the Federal Reserve would be lowering interest rates would I consider that being an opportunity to get in. But based on what Jerome Powell said today, he said, listen, our goal is 2% inflation, and we're not lowering the interest rates anytime soon until we get multiple reports, because he said we don't want these reports to come in and see high inflation reports, but because in quotes say they're because it's caused by the tariffs, and then we're going to have to raise rates even higher. So they're going to hold rates steady where they're at. And so we're getting this stagflation type atmosphere where rates aren't really high enough to cause complete demand destruction, but they're not really low enough to cause a stimulative effect in the economy. So it's like the stag kind of economy that we're in. And so in that environment, especially now with the tariffs, the market to me is highly overvalued. And when I can get still on a short-term basis, on a 6-month basis, 4% return on my money, I'd rather take that than risking losing another, 20 to 40% in the market. Now, if you're a trying to build your net worth and build your assets, finding ways to dollar cost average to build over the long term. But for people with a significant net worth, I wouldn't be nibbling at these prices until there's a little bit more clarity, or at least things were even more reasonable. But right now, my call is that the economy, there is no growth. You don't want to pay for growth that isn't there. And things like Tesla are highly overvalued and are running on vaporware, and the risk to the downside and much lower downside is high.
Greg, you were awesome, and thank you for hopping on such short notice.
My pleasure. My
Please
pleasure.
fill everybody in about your great Substack and your information and your handle on X.
Great. Yeah. So I appreciate everyone listening to me. I hope you guys appreciate it. If you want to learn more, I go into a lot more detail explaining all of the jargon that I was putting out today on the podcast. Make sure you go to Coastal Journal on my Substack, as long as my handles. And Greg Crennan is my personal account, and Coastal Journal is my news account. So for everyone to be out, stay alert, make sure you sign up and get weekly reports and analysis on all these trends.
Thank you so much, sir. And now, somebody who has built up a little bit of tension, probably because he's like, see, I told you so. Six, take it away. Uh-oh. Six, are you there? Or did our host go through a tunnel like he worried about? This is not a good sound here, folks. We're trying to get Six on here. Six, can you hear me, sir? Well, we don't have him on here yet. Kalani, are you there? I got to find Kalani on here, folks. This is crazy. This is X at its best, when it doesn't sit there and actually allow you to do what you think that it's supposed to do. And this is the aggravation that we have to deal with trying to host these shows. There's Kalani. I see him in one, but I don't see him on my phone, which is very bizarre. So that's because that's where I have to do the hosting. And of course, America, we have a problem, Houston, because this is how our stupid, idiotic Dear God, Elon, you've got billions of dollars. Fix this crap, you idiot. There we go. We got Kalani on. Kalani, how you doing, sir?
I'm good. How you doing, John?
Pretty good. I'm waiting on Six to reconnect, but I want to sit there and get your opinion as a experienced individual in the financial industry, and to sit there and provide some perspective. I believe,
John,
and
can
tell
you
me
hear me?
how. Nope, Six is back. Sorry, Kalani, I'm going
All
to bring
right.
both up because Six is on the road.
Yeah,
Kalani,
let
can you
six
hang in
go.
there?
Yeah, let six go. Go ahead.
Go ahead, Six. Take care.
Oh man, this has been such a week. I just want to say that we've been talking for over a month now about how Washington is the key driver of alpha in this recent set of market moves. Who knows whether or not that will continue? Sure, but right now, I think not enough people are paying close enough attention to the fact that this administration is the most direct and open administration that we've seen in maybe ever. They're on every single day. You have Lutnick, Besant, Trump's daily filibuster in the Oval Office. They're telling us exactly what's going on at every stage of the game. And I think that fading them is just absolutely silly. Um, what's their stated goal? Lowering the 10-year yield. They can't say it enough. So where is the Trump put on stocks is the wrong question. It's how aggressive do they want to be in getting the 10-year yield down? The fiscal put is on bonds, it's not on stocks. Besant has said over and over again that the stock market is not driving outcomes. And he said several times now, which I think is really interesting and really important, that they're that if in 2007 someone had metaphorically taken away the punch bowl, that we wouldn't have had 2008. And he said again today in his interview with Tucker Carlson that they're trying to avoid a financial calamity. Now, this man, the stock market is crashing while he's on this podcast, and he seems completely unbothered by it. He does not care. This is one of the smartest macroeconomic minds in the world to ever live, and he's sitting in the Treasury, the most overqualified Treasury secretary that we've ever had, the protege of Stan Druckenmiller and George Soros, the best two traders that have ever lived, and, well, Jim Simons, but that's a quant. And they're telling us exactly what they're going to do. Now, I am not interested in buying the market until they tell us that, or give us a signal that that is reasonable. And I think that they will, because they're in there every single day telling us exactly what's going on, being more than transparent. And they truly seem to believe that they're trying to reshape the global order. Now, what does that mean? Stocks are not going to be saved. They want treasury yields lower. They have an enormous amount that they have to refinance this year in federal debt. And Janet Yellen absolutely screwed the pooch when she issued debt during COVID, lots of debt during COVID, on the front of the yield curve, trying to juice the markets and get a slightly lower yield when she could have just been issuing 30-year notes, 10-year notes, the odd 20-year note. We could have been free from this debt burden, but now she has stuck the incoming administration with it. And Scott Bessent is probably the one doing a lot of the financial planning of this organization as it relates to markets. And I don't know why we would ever fade that. Today we had some interesting action in the curve. Z5 SOFR, so the SOFR contract that begins at the December contract and goes for a period of 90 days after, and measures the average SOFR rate over that time frame. Bid up. It started in the overnight session. The bid really started around 5 a.m. today, and it bid up 30 basis points today, which means that today alone they priced in more than a full rate cut at the peak. Jerome Powell came in and remained hawkish. The market did not like that. SOFR futures retreated off of that. So did bonds. So did treasury yields across the curve, really. And it's interesting. to try to decipher whether the reason for the sell-off was a peak in risk-off bets or if it was because of the lack of rate cuts implied or a mixture of both. Now, interestingly, on the SPX, we are now to the point where we were at the August sell-off. But if you look at the futures action into the close, we sold off nearly 100 handles on SPX, or on ES, sorry, into the close in the last 15 minutes to just cap out a brutal week. If you look at the daily candlesticks this week, Wednesday into Thursday opened down. It's just a full red bar and then another gap down and another full red bar. I think what's truly despicable is how many of the big accounts on this platform I've seen this week just take accounts that they know themselves are responsible for a lot of lesser informed people that are either new to trading or novices. They rely on these people to give them good advice because they think that they're smart. I saw an enormous amount of these large accounts that should know better telling everyone to buy the dip on Wednesday and then to buy the dip again yesterday. And this is into 5% down days. And I won't forget who said that. And I don't think anyone should ever take their advice ever again, quite frankly. That's all I got, John.
John, you there?
Kalani, how you doing? What are you thinking?
I'm just wondering what happened to John. John, you there?
Can you hear me now?
Yes, we can hear
I
you.
swear to
We can
God,
hear you.
X is glitchier than America Online.
All right.
Kalani, what's your take on the market?
Honestly, like the first thing I thought to share was it's been really, really orderly sell-off. People wonder how it's so orderly. It's because people are still buying the dip. I mean, you talked about this a little bit, Six, and people are still being encouraged to buy the dip. That's the if you're buying here, you're basically exit liquidity for hedge funds, and I don't recommend being in that position.
This is like the falling knife of all falling
Yeah,
knives to try to
yeah.
catch. I mean, look at this fucking chart. It's insane. It's insane.
So, the last couple of days, I'm being constantly asked by friends, family, followers, whatever, asking, hey, when's the selling going to end? When's the selling going to end? And I that's to me the wrong question. They're hoping that it doesn't carry over to next week. And the truth is, nobody knows when the selling is going to end at this point. And I like what Six had to say about, hey, they're telling us exactly what's happening. We should be listening to them. So, I personally think that the selling is going to continue, like a lot of you, and for a variety of reasons. First, I don't think we've seen real panic at all. I know we haven't seen real panic yet. I know what real panic looks like. I've lived through it too many times. The VIX finally started moving in a big way up today. And then
Uh-oh. Well, I'm back in here, folks, so I don't know if you can hear me or not. Six, can you hear me?
Yes, sir.
Well,
you guys can hear
Kalani
me?
just got muted. But Kalani, can you hear me?
Yeah, no, I'm sorry. I had an incoming call.
That's
And
okay. This is for both of you. So Six, you first, Kalani second. Here's
hey,
where I'm
John,
going to go with this.
can I get through some thoughts first?
Go ahead, sir. Go ahead.
Okay. So what I was saying was I'm being constantly asked when the selling will end. People are hoping that this doesn't carry over to next week. Um, I don't think anybody knows, but I don't personally think the selling's over. We haven't seen real panic. I mentioned the VIX. I don't know if you folks heard that. The VIX finally started moving up in a big way today. And in a typical bear market, that doesn't end after just one day. Um, as I previously stated, people are buying the dip. I want to see that decrease significantly before I feel comfortable thinking that the selling is over.
Yeah, like yesterday we had the JP Morgan said it was the biggest retail buying in 10 years in one day. That's not what
Exactly.
you see near the bottom.
Exactly. Investors are today. Investors were hoping Jerome Powell would announce emergency rate cuts. Investors have I've done my damnedest to try to eliminate this misperception, but investors have a misperception that rate cuts and QE, quantitative easing by the Fed, are immediately bullish. That is not true. If you're a student of financial history, you know that's not accurate. Most of the time, markets get spooked when emergency measures are taken like that, at least initially. And what I see very few people talking about is what Trump is trying to do is shift from a global economy to a more insular protectionist economy. Hey, that's great. I'm not going to get into the politics of that. I'm not going to debate politics here or anywhere with anyone. But that doesn't happen in one day or in 1 week or even 1 year. It's a complete regime change, and it's going to cause tremendous economic pain for a very long time if they continue down this path. Thinking that it can happen with a flip of a switch is absolutely ridiculous. Companies aren't going to reshore. They want them to, but they're not. It takes years to reshore manufacturing. They're going to hunker down, they're going to wait 4 years and hope for a new administration in 4 years. That means global commerce comes to a screeching halt, and it has, and it will continue unless they change the course. And then finally, the yen carry trade. That only seems like it's just started to unwind in the last 2 days. And even then, not by much. Today was the first day that we saw the dollar go up noticeably, or the DXY index. When there's real panic, there's usually a flight to the safety of the dollar. And we haven't really seen that yet. So, more than anything, this episode makes me think about how ridiculous our economy and financial markets have been for years. Don't ever say that nobody could have seen this coming. Regardless of tariffs, this outcome was and is completely inevitable. We've had years and years of the worst malinvestment the world's ever seen. We've had SPACs, NFTs, zero-day options, crypto, all of all of it a result of way too much liquidity from the Fed and record deficit spending sloshing around the economy like free coke or cocaine. Actions have consequences, and what we're seeing now are what I think is the beginning of those consequences coming home to roost. That's my rant.
Amen, brother.
Thank
Well,
you.
Very well said.
six, Kalani, you guys have sat there and brought it up, so I'm going to go to six first. Kalani, you second. Please both answer in order. And this is important. Um, a lot of people are looking at the sudden reversal in the yield curve this morning to this afternoon. We were really drastically down on the yield curve. However, what if intelligent nation, idiot, who think, oh, it's just a flight to safety, didn't realize that the Asian nations were selling into the bond market rally? Everybody looks at yields. No one looks at price. Six, tell the truth. If you see something go up 40 points and you know it's 110% BS, you're selling into it to make a profit. Does anybody think Asian banks are stupid?
I sold into it today and made a huge profit. So, yeah.
Kalani?
I'm going to defer to Six on this. I'm not a fixed income guy. I mean, I feel very comfortable talking fixed income, but I'm more of an equity options guy. So I agree with.
So I'm going to go with you then on another question. Every idiot who's been buying bullish options, are not overseas entities selling into every bull BS move or intraday rally? Because that's the smart thing to do.
Absolutely. I just posted a chart from God, who is that? From Bar Chart. Yesterday, hedge funds dumped hedge funds dumped global stocks on Thursday at the fastest pace in history. This is exactly what Six and I are talking about. If you're trying to catch this falling knife, if you're buying the dip here, you are their exit liquidity. That's not even up for debate.
Okay, I'm going to finish this off with Six and Kalani both answering a question which nobody wants to answer because I'm asking it. Six, what's your dartboard for Monday? I think Asia goes to hell in a handbasket and they begin liquidating United States bonds, dollars, and other U.S. dollar denominated assets. Your take.
I genuinely have no idea what's going to happen on Monday. I'm not sure what kind of news we're going to hear this weekend. If there's some sort of moderation, I wouldn't be surprised at this point to have the well, whether or not they frame it like that or we ever even know it. I wouldn't be surprised to see the Trump administration privately reaching out across the ocean to make some deals to try to get some good news in there. Because I mean, even though they are not concerned about the stock market, this is just not good PR for them. And if this goes on much longer at this rate, I'm not saying that we don't inevitably go much lower, but just the velocity of this sell-off is very troublesome from a PR standpoint.
Okay, now I'm going to go back to the follow-up question to you because you're right there in this, and Kalani gets the joy of answering this. Some of us old son of a bitches were around in 1987 and watched this live on the Financial News Network. Shut up, don't make fun of my age, everybody in the audience. During that period, everyone forgot the preceding 4 days. Santoli had a flashback. He must have watched some VHS tapes stuck in his daddy's attic. What do you make of this week and the threat of the cascading failure, which is possible because everybody had so much faith in the technical support for the markets? However, at some point, everybody says the hell with it and walks out.
Yeah, I mean, that's starting to become a much more serious possibility. Without the Fed, just today, basically, Powell is not there to support the market. He's worried that tariffs are going to cause more inflation. He's not there to protect the market. You have the administration that is very clearly there for the bond market. If we had the market go to absolute shit on Monday, treasury yields would fall greatly, which is exactly what they want. They probably didn't want it this quickly, but that is their ultimate goal. There's just the helping hand for stocks of the fiscal and monetary side of the equation they're gone. So this could get a lot worse, and it's led by the tech stocks that the bubble was pricked when DeepSeek came out. It wasn't the tariffs. This was the DeepSeek was the body shot. This was the headshot. And I mean, maybe we open up on Monday and we start a bear market rally before going lower, or maybe we just continue to free fall. I really don't know.
Hey, John, can I just say, I'm sorry, but I think
Hop in, please.
Six is 100% right. This is about DeepSeek. And we go back, and whatever, who funded it, how cheap it was, none of that matters. There are actually engineering concepts that transcended what people were thinking was possible. And so it changed the game. And everybody is late to this understanding. So whether or not it doesn't happen immediately, ever, but that was a very important moment. And by the way, guys, it's about to get much worse from here because that was the initial engineering, accomplishment. Once other people realize that was possible, it just escalates from here.
Yep.
Kalani, I'm going to hit you with the same question, but with a different twist.
Okay.
Retail has not capitulated.
Nope.
Retail, once again, demonstrates they're retarded. Hey, before you criticize that word, everybody That must know Trump signed an executive order saying it's okay to use that. Nobody special wants to jump in because I'm going to give you a chance to answer this in long detail to close the show out, Kalani. And think about it. I'm going to let nobody special come in real quick. Folks, the disaster we're looking at is something that retail has never experienced. So while nobody special goes in here, I want you to think about something and then come back and close this show out for everybody because, folks, I'm from the supply chain side of things. Nobody has taken this into consideration. Nobody has taken into consideration 2 quarters of inflation followed by actual deflation. And that is why markets are freaking out. And I said that technical violations occurred all the way down this past week. The technical violations were excessive compared to other declines. Everybody will back me on that. We break below 4,800. There's a lot of room, some historical lows that we haven't seen in quite a while. Nobody special, take it away before I let Kalani go on his rant.
I just want to add to what Melody was saying about DeepSeek there. The other angle of DeepSeek that the market really glossed over is the crime, the illegal sales to China. You know, there's this guy on X named Kakashi. He's been talking about the illegal sales to China through Singapore of these GPUs for well over 2 years. And after DeepSeek, all of a sudden, Silicon Valley just kind of tacitly acknowledges, oh, yeah, we know they have 50,000 H100 GPUs. Well, how the hell did they get them? It's illegal to sell them there. And NVIDIA is getting 20% of their revenue from Singapore, a city, one city country, 20% of their revenue, which is billions of dollars. They have been illegally selling their chips to China, or at the very least, turning a blind eye to it at such a scale that rises to the level of crime. And any day now, windbreakers could bust into their offices and start hauling out boxes of documents prosecuting this crap. And everybody, I mean, what happens to the NASDAQ if all of a sudden we learn that 20% of NVIDIA's earnings have been coming from export control fraud? Oh, by the way, Trump just launched a trade war. He's not afraid to blow up the stock market to fight this stuff. And everybody's just kind of ignoring that this is going on. That is huge. And I've done videos on my channel. I've got video and pictures of warehouses full of Supermicro servers, Chinese tech bloggers holding up H100 saying, here's my illegal H100 GPU, and I got my hands on it anyway. It's so obvious this is happening. Any day now that could blow up. And they're already probing it. The DOJ and the SEC, they're already looking into it.
Thank you. Nobody special. That's at JG Nuke on X. And folks, he's 100% right. I've watched his videos, and on the quote unquote Chinese version of eBay, there's a lot of suddenly mysterious NVIDIA GPUs for sale there. Kalani, we've given you a full plate. Please eat, sir.
Okay, repeat the question. I just want to make sure I nail this.
Okay. We're looking at a technical violation of all support levels dating back to last year and then some. We're also looking at retail still living in this unicorn-filled world of disbelief. If retail were to get more bad news Sunday night, which I think is highly likely with the Asian reaction to our tariffs, because you can't offend these people without expecting consequences. One thing I learned going out with the Taiwanese is you bring lots of scotch, you entertain them, and you respect them. The disrespect we've shown to East Asia is going to come back at us as a boomerang. And they might teach us a lesson by starting to liquidate our credit and our equities overnight while everyone is asleep, as you so eloquently said. Folks, I want to know what happens when retail folds. You've been there. You've done that, sir. Fill everybody in.
I have the scars to prove it. You know, I'll share I don't know if it's a specific story, but a general story about 2000. I think that'll answer the question. Retail needs to wake up. That's what needs to happen. And if they don't, they're going to get hurt. And it's going to be, they're going to feel the pain like they did in the great financial crisis and also in the 2000 crash. And the problem is there's a lot of market participants right now that are, bulled up that haven't experienced a real recessionary crash like those two were. So In 2000, I was managing option and equity trading desks for a brokerage firm, and during that crash, there were so many margin calls that the margin desk was always asking us for help. And so, as any good manager, I jumped in and I participated in selling customers out. Most of the time, I would be able to get them on the phone and I would talk to them. Sometimes I wasn't able to get them on the phone. A lot of people didn't have cell phones back then. And if we couldn't get them on the phone, we just started blasting away. It was arbitrary. We didn't pick and choose. We just sold the first things that we saw and got it done and moved on to the next customer. And what really sticks in my mind from that period more than anything are grown adult men crying to me on the phone. And I was 29 and 30 years old then. And it shook me. I would go home some days and it took me hours to wrap my head around some of the conversations I had with individuals. And we're talking about people who went from a positive $100,000 or $200,000 in equity in their brokerage accounts, a day or two later, negative equity. And I know for a fact that some of those losses resulted in divorces and in filing for bankruptcy and on and on and on. And that's why I've devoted so much time and effort, whether it's just talking to friends and family and acquaintances, or whether it's here on this app, trying to caution people to think critically and be cautious and not take risks at the end of this cycle, at the end of any cycle. So that's the best way I can answer that question, John. It's just stuff like this leaves scars, sometimes generational scars, and you don't want that to be you.
Thank you, sir. And guys, I got to wrap this up because our host is getting ready to go through a tunnel, which will probably kill the X connection because X is held up by squirrels, baling wire, and apparently we found out where the engineers are in Lesotho. I'm going to sit there and summarize this really quick. I was around for 1987. Had just finished college, got my first major position in a company, working for a trucking company. I had gotten home, turned on the TV, saw the market cratering. I mean, absolutely tanking towards a 23% one-day decline. The next day, the stories started coming out because we didn't have the internet. Believe it or not, we didn't have cell phones either, boys and girls. It was what us old people call linear cable television. So here we go with linear cable television. And I'm sitting here thinking, well, nothing else could be happening. The next day, I heard about a story in Miami. In those days, if you're not an investor, you had to depend on your broker. It's what killed me in 2000 because there wasn't really online brokerages to any extent, and day traders were reserved to special dedicated lines, etc. Very expensive, very hard to deal with. So I'm sitting here watching the news, and a guy who tried to call his broker, a retiree, lost everything in 1987. He walked into the Merrill Lynch office, saw his broker, saw the phone off the hook that afternoon at 4:05 p.m. and put a .44 Magnum round through his head and then killed himself in the office. I pray to God we don't have to go through that again. But a lot of people don't understand the desperation and family trials and tribulations that people went through in 1987, in 1991, in 2000. And a lot of people, especially those in the financial industry, of which there were zero major convictions, putting people who live in their cars in 2009 didn't give one, pardon the word, shit about. They let them live in their cars and didn't care. Was it their fault? No, they should never have qualified for the mortgages. Just like people who shouldn't qualify for margin, just like people who shouldn't qualify for a Robinhood account with a 50% margin availability on subprime credit with a FICO of 700, on and on and on. We're at that precipice now. Pray to God we have some sane people take over. I'm not blaming Scott Bessent. I think he was thrown in there as a showpiece. He's there to say, look, we're legitimate. And I was terrified and praying to God that we had adults in charge again. Instead, we brought in the circus clowns, and the tariff rollout and the consequences thereof, especially in credit and equities, private equity and industry, is now being reflected. Pray to God we're not doing a special show on Monday. For MacroEdge Radio, go to macroedge.net/ozone. Get your 2-week free trial. macroedge.net/ozone. You can also read my stuff at johngaltfla.com. I will be writing for macroedge.net Sunday night. I have a funny feeling we will have a lot to discuss. Good night now.